Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. So, you did it. Your company went international, you set up shop in another country, and guess what? It's a huge success. It's actually making money, and that is fantastic news. But, and it's a big but, it brings up this really tricky question. How in the world do you get that cash back home? Well, let's dive right into this because it's a super important piece of the global finance puzzle. All right, so here's how we're going to tackle this. First, we'll lay out the basic international puzzle. Then, we'll look at the four main paths for cash to flow. After that, we'll get into the really fun part, navigating the tax maze. Then we'll talk strategy, and finally, we'll cover the fine print. You know, the rules you've got to follow. Okay, let's really set the stage here. Imagine this. You've put in all the hard work. You've built this amazing, profitable business in another country. Awesome. The money's piling up, but it's in a foreign bank account. And you need that cash back home, right? Maybe for paying out dividends to your shareholders, maybe for some new investments, or maybe just to make your balance sheet look stronger. The problem is getting it from there to here. Yeah, it is not as simple as just hitting send on a wire transfer. And that really is the million-dollar question, or maybe billion-dollar question for so many multinational companies. See, it's not just about moving the money, it's about moving it smartly. You have to do it efficiently, you have to do it legally, and you've got to do it in a way that makes the most sense for the whole company's bottom line. And this right here, this visualizes the whole thing perfectly. It's basically a two-way street. You've got the parent company, in this case a Canadian one, sending resources down to its foreign subsidiary. We're talking about things like cash, equipment, technology, you name it. And in return, what comes back up? Cash, but it comes up in a few different ways. And that relationship, that flow, is really the foundation for everything we're about to get into. Now, this is an absolutely critical distinction, and it changes the entire game. If your foreign operation is just a branch, it's legally the same company. Easy peasy. But a subsidiary, which is what we're talking about here, is a totally separate legal entity. Now, that might sound like boring legal stuff, but trust me, it's a huge deal. Because it's a separate company, you can't just move money around internally. Nope. You need formal, legitimate, justifiable payments. And that's where our four paths come in. So if you can't just do a simple transfer, how do you get the money home? Well, the first thing that probably pops into your head is dividends, right? And that's one way, for sure. But it's only one piece of the puzzle. There are actually four really powerful channels you can use to create a steady stream of cash flowing from that subsidiary right back to the parent company. And here they are: interest, rent, royalties, and management fees. These are your four main options. Now, what's important to remember is that each one is a payment for something specific that the parent company provided, and they each have totally different tax consequences. So let's break down what each one actually is. Okay, first up, we've got interest. This one's pretty simple to wrap your head around. The parent company loans money to its new subsidiary, right, to get it off the ground, to help it expand. Well, the subsidiary has to pay that loan back, and it pays it back with interest. It's a payment for using the parent's capital, exactly like a loan you get from any bank. Next on the list is rent. Let's imagine the parent company owns some really specialized, super expensive piece of machinery. Instead of just selling it to the subsidiary, it can lease it to them. So the subsidiary gets to use the equipment, and in return, it pays the parent company a regular rental fee. Simple as that. Then you have royalties. This one is all about the intangible stuff. Think about it. The subsidiary is probably using the parent company's brand name, right? Or maybe a special patented manufacturing process, or some proprietary software. For the right to use that valuable intellectual property, it has to pay a royalty fee. And last but not least, management fees. You know, the parent company is often providing a ton of support from headquarters, things like high-level strategy, accounting help, IT services. Well, it can charge the subsidiary a fee for all that support. The key takeaway for all four of these is that they aren't just random payments. They have to be real, justifiable business expenses for the subsidiary. Okay, so now that we have our four paths, here's where things get really interesting. And let's be honest, a little complicated. You can probably guess that foreign governments aren't too thrilled about the idea of all this money just flowing out of their country before they get their cut. And that, my friends, brings us to the tax maze. So, to make sure they get their slice of the pie, foreign countries use something called a withholding tax. It's exactly what it sounds like. The subsidiary has to literally withhold a chunk of the payment that's supposed to go to the parent company and send that chunk directly to its own local government. Think of it as an exit tax on money leaving the country.
And you have got to see this. This table shows just how wild the differences in these tax rates can be. I mean, they're staggering. This is a real-world example for a U.S. subsidiary paying its Canadian parent. Look at this. Interest and management fees, 0% tax. Great. Royalties are at 10%. But rent gets slammed with a massive 25% tax. This just goes to show you, choosing the wrong path can be a really, really expensive mistake.
To really see how this all fits together, let's just follow the money. We'll use a simple, practical example. Let's say our U.S. subsidiary is sending a $10,000 royalty payment up to its Canadian parent. How does the tax actually get calculated in both countries? Let's walk through it.
All right, let's break down the numbers. The subsidiary is sending 10 grand. The U.S. government, with its 10% withholding tax on royalties, immediately takes $1,000 of that. So only $9,000 actually arrives in Canada. But back in Canada, the parent company has to declare the full $10,000 as income. Now, let's say the Canadian corporate tax rate is 27%. That means its tax bill should be $2,700. But, and this is the most important part, Canada gives the company a foreign tax credit for the $1,000 it already paid in the U.S. So instead of paying $2,700, it only has to pay the remaining $1,700 to the Canadian government.
So what's the bottom line here? The total tax paid is $2,700. That's the $1,000 that went to the U.S. plus the $1,700 that went to Canada. Notice anything? It's exactly what the Canadian tax would have been in the first place. The whole system is designed to stop companies from being taxed twice on the same income. So the withholding tax doesn't really change the total amount of tax you pay, it just changes who gets paid. It's all about allocating that tax bill between the two countries.
Okay, so knowing the mechanics is one thing, but using them to your advantage, that's where things get strategic. This is where a smart company can create some real value. And the best strategy for you is going to depend entirely on one thing. Is your subsidiary in a country with high taxes or low taxes compared to back home in Canada?
So you've really got two basic scenarios to think about. Scenario A, the foreign country has a higher tax rate than Canada. Scenario B, the foreign country has a lower tax rate. Your goal, what you're trying to achieve financially, is completely different in each one. All right, let's say your subsidiary is in a high-tax country. What's your play? Simple. Your strategy is to get profits out of that country as quickly as you can before they get hit with that super high tax rate. And the smartest way to do that is to fund the subsidiary with debt, with loans. Why? Because those interest payments the subsidiary makes back to the parent are a tax-deductible business expense. See what that does? It lowers the subsidiary's taxable profit in that high-tax country and moves that income over to Canada, where it gets taxed at a lower rate. The end result? A smaller overall tax bill for the entire company. But what if you're in a low-tax country? Well, you flip the script completely. You do the exact opposite. Now your strategy is to keep as much profit as you can inside that country to take full advantage of that sweet low tax rate. So here, you fund the subsidiary with equity by buying shares, not with debt. You'll get your money back through dividends, which are paid after taxes. They aren't a deductible expense. This keeps the profits parked in that low tax place, maximizing your tax savings. Now, I know what you might be thinking. This all sounds like a really clever way to play the system and minimize taxes. And, well, it is. But it's not the Wild West. It's not a free-for-all. Tax authorities, the IRS, the CRA, they're not dumb. They know all about these strategies, and they have some very important rules in place to make sure nobody's taking advantage. And that brings us to the big one, the most important rule of all, the one that governs everything we've talked about. You can't just invent a crazy inflated interest rate or a massive management fee just to suck profits out of a country. No way. All of these payments, the interest, the rent, the royalties, they have to be reasonable. They have to reflect fair market value. It's what they call the arm's length principle. Basically, would two totally separate, unrelated companies agree to this price? It has to be legit. You can be strategic, but you can't abuse the system.
So let's wrap this all up with a final thought. Getting cash back home from your foreign business, it's so much more than just an accounting task, isn't it?
Once you really understand these different paths and you get a handle on the tax rules and you see the strategic choices you can make, it becomes this incredibly powerful tool for managing your global finances. So the question you have to ask yourself is this: for your business, are these cash flows just transactions, or are they a strategy?